Silver update. Fed strain and economic warning signs. Right now, somewhere in the global financial system, a signal is flashing. Not in the headlines, not in the news you're watching, but buried inside freight data, inside bond yields, inside a currency that refuses to weaken. And silver is caught in the middle of it, holding, barely. There's a number on the chart right now, a line in the sand that, if it breaks, changes everything we thought we knew about this market. And there is another number above it that almost nobody is watching that could unlock the next major move. By the end of this video, you will know both of those numbers, but first, you need to understand exactly why the pressure is building and why this warning sign cannot be ignored. Now, before we go any further, I want to ask you for a small favor. You know, in life, the most valuable things are rarely loud. A good piece of advice, a trusted friend, a steady hand to hold on to. And honestly, hitting that subscribe button is a bit like that. It costs you nothing, but it means everything to us, and it makes sure you never miss a warning sign like the one we're about to break down today. So if you haven't already, go ahead and subscribe. Consider it a quiet little promise between us. And one more thing, I'd love to know, where in the world are you watching this from today? Drop your city or your country down in the comments below. It always amazes me how far and wide this community really stretches. All right, now let's get into it. Across trading floors and small home offices alike, the same question keeps surfacing among silver investors this week. Why isn't the price moving? The metal sits in a strange position. Demand remains strong. Supply remains tight. By most accounts, the world is in its sixth straight year of a structural silver deficit, meaning more silver is being used than is being mined and recycled combined. And yet, despite all of this, the price refuses to break out. For many investors watching their portfolios, this silence feels almost unnatural, given everything happening around the globe. To understand what is really going on, analysts say investors need to look past the price chart and into three forces working together. They call it a triple pressure, and each piece reinforces the other two. The first piece is the Federal Reserve. When the central bank signals that interest rates will stay elevated for longer than expected, it changes how money behaves across the entire financial system. Higher rates make bonds and savings accounts more attractive because they pay a guaranteed return. Silver, by contrast, pays nothing while it sits in a vault or a safe. It only earns money if its price goes up. So when safer assets start paying well, large investors quietly shift their capital away from metals like silver and into interest-bearing assets instead. It is not dramatic. It is not a single big sell-off. It is simply billions of dollars moving, quarter after quarter, toward the safer, more boring option. The second piece is Treasury yields, and this connects directly to the first. As the Fed holds rates higher, the return on government bonds climbs alongside it. For institutional money managers, the people responsible for pension funds, insurance reserves, and large investment portfolios, this matters enormously. Every dollar placed into silver is a dollar not earning that bond yield. Multiply that decision across thousands of fund managers, and the cumulative effect becomes a quiet but persistent drag on silver's price, even while the underlying fundamentals remain strong. The third piece is the US dollar itself. A strong dollar makes silver more expensive for buyers using other currencies. Someone in Europe, India, or Southeast Asia looking to buy silver must convert their local currency first, and when the dollar is strong, that conversion costs more. This naturally cools international demand at the exact moment when conditions might otherwise favor higher prices. Individually, each of these forces would create mild pressure. Together, analysts argue, they form a wall that has been remarkably effective at keeping silver's price contained even as the deficit story continues to build in the background. There's also a seasonal factor working against silver right now. Summer months have historically brought lower trading volume and reduced enthusiasm across metals markets. Fewer large trades, fewer headlines, fewer reasons for institutional desks to make aggressive moves. This seasonal quiet often amplifies whatever pressure already exists, making a contained market feel even more contained. For business-minded observers, this is where the story becomes genuinely useful. Markets do not move in straight lines, and short-term suppression is not the same thing as long-term invalidation. A disciplined investor learns to separate the two. The Fed's current stance, the yield environment, and dollar strength are not permanent conditions. They are policy decisions and market conditions that shift as new economic data arrives. The structural deficit, on the other hand, does not disappear because of a single Fed meeting or a strong jobs report. It is built on years of mining shortfalls and rising industrial consumption that cannot be reversed quickly. This is the first lesson serious observers take from the current setup. Temporary monetary pressure and long-term structural reality are two completely different timelines, and confusing them leads to poor decisions. Reacting emotionally to a quiet summer market, when the underlying deficit remains unchanged, often means missing the real opportunity entirely. But the monetary side of this story, as significant as it is, only explains part of why silver remains capped. There's another signal developing, quieter, less discussed, and arguably more important, coming directly from the industrial side of the economy. It involves something most retail investors never think to check: freight and trucking data. And what it reveals about the real economy right now is the next piece serious decision makers cannot afford to ignore. While most investors keep their eyes fixed on interest rate decisions and currency charts, a different signal has been forming far away from any trading desk. It comes from highways, shipping yards, and warehouse loading docks. Freight and trucking data, the kind of information that rarely makes financial headlines, has been showing real weakness in recent months. To the average observer, this might seem irrelevant to a precious metal sitting in a vault. To anyone who understands silver's true identity, it is one of the most important signals available right now. Silver is often discussed as a monetary asset, something people buy as protection against inflation or currency devaluation. That description, while accurate, only tells half the story. Silver carries a second identity that gets far less attention. It is one of the most heavily used industrial metals on the planet. It runs through solar panels, electric vehicle components, medical devices, and the electronics inside nearly every modern gadget. Unlike gold, which is mostly held as a store of value, a substantial portion of silver's annual demand gets consumed permanently in manufacturing processes and never returns to the market. This dual identity is exactly why freight data matters so much. Trucking and logistics activity acts as an early warning system for the broader industrial economy. When factories slow production, fewer goods need to move. When fewer goods move, trucking companies see lower volumes, and that shows up in the data well before quarterly earnings reports or official economic releases confirm a slowdown. Right now, that data is sending a message that the industrial engine driving a large share of silver demand may be cooling. This creates a genuine puzzle for anyone trying to understand silver's price action. On one hand, the world is experiencing a structural deficit, meaning total demand has outpaced total supply for 6 consecutive years. On the other hand, weakening freight numbers suggest that one of the largest demand drivers, industrial consumption, could be softening at the exact moment supply remains constrained. These two realities are not necessarily contradictory. A deficit can persist even while growth in one demand category slows, particularly if mine supply and recycling rates remain weak at the same time. But for short-term price action, the industrial slowdown acts as a ceiling, limiting how aggressively buyers can push silver higher until clearer signs of industrial recovery appear. Layered on top of this domestic economic picture is a geopolitical dimension that has added further complexity in recent weeks. Tensions in key shipping regions have raised concerns about disrupted trade routes and constrained logistics networks. When critical maritime corridors face uncertainty, the ripple effects extend well beyond oil markets. Global supply chains, already adjusting to softer freight volumes, now face an additional layer of friction. Historically, this kind of geopolitical stress tends to push capital toward oil and energy markets first, while metals like silver and gold experience a more complicated reaction, caught between safe haven buying interest and concerns about slower global growth. This combination, a domestic industrial slowdown paired with geopolitical shipping uncertainty, explains why silver's price has behaved in a way that confuses many newer investors. Rising tensions around the world would typically be expected to push precious metals higher as a safe haven response. Yet silver has remained largely range-bound, and in some recent stretches, even moved lower while oil prices climbed. This is not silver malfunctioning. It is silver responding to multiple competing forces simultaneously, with industrial demand concerns currently outweighing safe haven buying interest. For business-oriented investors, this section of the analysis carries an important lesson about reading markets correctly. A single data point, like a structural deficit, never tells the complete story on its own. Markets respond to the interaction between multiple forces at once, and ignoring one half of that equation leads to confusion about why prices move the way they do. The freight data, the geopolitical backdrop, and the deficit narrative all need to be held together in the mind simultaneously, not viewed as separate, unrelated stories. What this means going forward is straightforward but important. Until industrial activity shows clear signs of stabilizing or improving, silver's upside will likely remain capped by this demand-side hesitation, regardless of how tight the supply situation becomes. The structural case for higher prices over the long run remains intact, but the path to get there in the near term runs directly through the strength or weakness of the global industrial economy. This raises a critical question that the charts themselves are now beginning to answer. At what price level is the market drawing its line, and what level would need to break before the next major move could begin? After working through the monetary pressures and the industrial warning signs, the analysis eventually arrives at the place most investors check first but understand last: the chart itself. Numbers on a price graph rarely explain themselves. They only become meaningful once someone connects them to the forces driving the market underneath. With that foundation already laid, the technical picture for silver now comes into much sharper focus. The first number worth noting is the support zone, sitting between $50 and $60. This range has held firm through multiple waves of selling pressure, despite a hawkish central bank, rising yields, a strong dollar, and weakening freight data, all working against the metal at the same time. That kind of resilience does not happen by accident. When a price level survives that much combined pressure without breaking down, what usually means buyers with genuine conviction are stepping in every time the price approaches that zone. These are not short-term traders chasing quick profits. These are accumulators who view $50 to $60 as a fair entry point relative to the structural deficit story discussed earlier. This is where the technical picture and the fundamental story meet directly. The support zone holds precisely because the long-term deficit narrative gives buyers confidence that current prices remain attractive, even amid short-term monetary headwinds. Take away the structural deficit, and that same support zone would likely have broken months ago under this much pressure. Its survival is itself a form of evidence, confirming that the long-term bull case has not been damaged by recent macro conditions, only delayed. The second number that matters sits much higher, $72. This level represents resistance, the point where previous buying pressure has consistently run out of strength. A clean, decisive move above this threshold would carry real significance. It would suggest that whatever combination of forces has been capping silver, whether monetary, industrial, or geopolitical, has finally lost its grip on the market. Breaking above 72 would likely attract a new wave of buyers, including momentum-driven capital that has been sitting on the sidelines waiting for confirmation before committing. However, a word of caution belongs here, and it is one that disciplined investors take seriously. Breaking above resistance does not guarantee an immediate, uninterrupted climb toward much higher levels. Markets have a well-documented tendency to consolidate after breaking key levels, moving sideways for extended periods before the next genuine leg higher develops. Silver has shown this exact behavior before, spending considerable time trading within a wide range before eventually pushing toward new highs. Anyone expecting a breakout above 72 to immediately translate into a rapid run toward $80 or $90 may be setting unrealistic expectations, even if the longer-term direction remains upward. This distinction matters enormously for how someone approaches their own decision-making. Markets reward patience far more often than they reward urgency. The investors who tend to do well over multi-year periods are rarely the ones reacting to every short-term move. They are the ones who understand the broader structure, identify the key levels that would actually change the picture, and then wait calmly for those levels to be tested, rather than guessing at every small fluctuation along the way. Right now, silver sits in exactly this kind of waiting period. The support zone has proven durable. The resistance level above remains untested in any decisive way. Between these two boundaries lies a market working through competing pressures, with neither the bulls nor the bears able to fully take control. This is not a market malfunctioning or behaving irrationally. It is a market doing precisely what markets do when multiple significant forces collide at once. It pauses, consolidates, and waits for new information to tip the balance. For serious observers, the message from the chart is clear and disciplined. Watch 50 to 60 as the line that, if it holds, confirms the structural story remains intact. Watch 72 as the line that, if broken cleanly, opens the door to the next major phase. And in between those two numbers, resist the temptation to overreact to every small swing. The real decision point has not yet arrived, but when it does, these are the exact levels that will signal it. You said, now move to the final part. 600 words. After working through the monetary pressures, the industrial warning signs, and the key levels on the chart, the analysis arrives at the question that actually matters most for serious investors. What should be done with this information? Understanding why silver is behaving the way it is provides little value unless it translates into a clear, disciplined course of action. The first principle worth establishing is a mental separation between short-term price suppression and long-term structural opportunity. These two things operate on entirely different timelines, and confusing them is one of the most common mistakes made by newer investors. The Federal Reserve's current stance, elevated bond yields, and dollar strength are cyclical conditions. They shift as economic data changes, as policy committees meet, and as global conditions evolve. The structural deficit, by contrast, is the product of years of underinvestment in mining capacity combined with steadily rising industrial consumption. One of these stories can change within a few months. The other took years to build, and will likely take years to fully resolve. This distinction leads directly to silver's role as a wealth preservation instrument rather than a speculative trading vehicle. For business owners and entrepreneurs accustomed to thinking in terms of long-term asset allocation, this framing matters. Silver, particularly in physical form, functions less like a stock chasing quarterly gains and more like a savings mechanism that exists outside the conventional financial system. Its value does not depend on a single company's earnings report or specific industry's quarterly performance. It depends on broader monetary and industrial trends that play out over years, not days. Given this framing, a disciplined accumulation approach becomes the logical response to current conditions. Rather than attempting to perfectly time a bottom, a strategy built around consistent, scheduled purchases through periods of volatility removes much of the emotional guesswork from the equation. This approach, often called dollar-cost averaging, treats price dips as opportunities to acquire more at favorable levels rather than reasons for concern. It also protects against the common mistake of waiting indefinitely for a perfect entry point that may never arrive in the exact form an investor expects. Of course, responsible analysis requires acknowledging risk honestly rather than assuming the bullish case is guaranteed. The support zone discussed earlier, sitting between $50 and $60, represents an important line. A clean, sustained break below that range would raise legitimate questions about whether the structural deficit narrative is being overwhelmed by demand destruction, severe enough to offset years of supply shortfalls. This would require a substantial deterioration in industrial demand, likely tied to a broader global economic slowdown extending well beyond current freight and trucking weakness. It is not the most probable outcome based on current data, but a disciplined investor always considers what would prove the thesis wrong, not just what would confirm it. Looking ahead, the next 1 to 2 quarters appear to function as a genuine observation window. During this period, the interaction between Fed policy decisions, industrial data trends, and the technical levels already identified will likely determine which direction silver moves next with real conviction. Rather than reacting to daily price swings, the more productive approach involves monitoring these specific signals, whether the Fed's tone shifts, whether freight data stabilizes or worsens, and whether the 50 to 60 support zone continues holding under pressure. For those approaching silver from a position of strategic patience rather than speculative urgency, the current environment represents exactly the kind of setup history tends to reward over time. Pressure builds, patience holds, and eventually, the levels that matter make themselves known.